Hi, I'm Alessia Di Camillo from Tenax Capital, and I'm here today with Marco Della Giacomo, Portfolio Manager, and Toby Pugh, ILS Analyst. Tenax Capital is celebrating a record performance, ranking as a top-performing ILS manager in the UCITS universe for the full year 2023. So, Marco and Toby, can you give us an overview of the ILS market in 2023?
Sure. As you said, ILS in 2023 had a record year. After 5 years of slow market hardening due to secondary peril losses, insurance premia finally reached adequate levels. Last year, thanks to Hurricane Ian and the inflation uptick we had globally, spreads in ILS reached all-time high. And this translated into the best risk-adjusted yields that we've seen in ILS in ages.
So immediately after Hurricane Ian happened at the back end of 2022, the cat bond market priced in an industry loss of around $75 billion. But as the year went by, this loss adjusted down to about $50 billion. So throughout the year, we saw sponsors reducing their losses overall. The net result of this was that yields started to adjust in the secondary market, spreads started to tighten, and quite aggressively in certain pockets of the market, especially for bonds that had index triggers. But ultimately, given the high level of exposure the cat bond market has to US wind and earthquakes, the performance of the market will always be driven by quiet and active seasons. Fortunately for us this year, it was very quiet on that front, and this resulted in the Swiss Re index returning around 20%, surpassing the previous record in 2007 of around 15%.
And how has the Tenax ILS fund performed in this environment, and which have been the key drivers?
We did very well. We delivered a close to 18% net return on our flagship Euro hedge class. This places our fund in the top decile of the entire ILS UCITS universe on a 1, 3, and 5-year basis. Our strategic call on industry loss trigger bonds have been key to achieve these results. Our timing was perfect. We identified the best entry point to increase exposure into that bucket. We then took advantage of new issuance premia far too high to be ignored in Q4 22 and Q1 23.
I think as well, an important factor is our bond selection process. So we leverage a number of in-house models, and we also use our underwriting expertise in every single deal that we actually look at. And thanks to this selection process, we managed to avoid 2 of the largest defaults of the year. One bond that covered mortality risk, and another bond that defaulted after Hurricane Otis in Mexico. Of course, part of our job is to forecast when and where these type of events are going to happen. But our primary role is to assess each deal and its risk-reward profile, which hasn't always been easy this year because we've been offered bonds that have had an extremely attractive spread, but experience tells us that if a deal looks too good to be true, typically it is.
So Toby, looking ahead, what's your outlook for the ILS market in 2024 and beyond?
So like Marco said earlier, the market has been hardening slowly over the last 5 years or so, but the real kicker came after Hurricane Ian at the back end of 2022. And the resulting renewals that we saw in 2023, especially those risks that were covering Florida wind. Pricing and terms and conditions have now reached a point where underwriters and investors are relatively happy. There's obviously always room to improve, but given the activity we've seen in the last few years, the market is in a very good place. Perhaps returns in 24 aren't going to be as extraordinary as they were in 2023, but this was a market that we haven't really seen in generations. But ultimately, we're still in a seller's market, so it's still a very attractive entry point for investors. In terms of risk appetite, I still think that secondary perils going into 2024 are going to be difficult to place for sponsors and also those lower down the reinsurance tower, as the market still has a preference for coverage that are clean structured and also have a named peril basis.
So Marco, to conclude, why should an investor look to allocate into ILS and into Tenax in 2024?
Sure, there is one reason which will always be true, and it's the lack of correlation of ILS with respect of traditional equity and credit. ILS will always materially improve the Sharpe ratio of a multi-asset manager portfolio. The second reason is the current relative value of ILS compared to other asset classes. For example, ILS has the potential to deliver double-digit net return to investors compared to high yield, where the potential is almost half of that. Then you ask me why Tenax. First of all, we have superior analytical capabilities. Second, we developed proprietary models that have allowed us to have a better risk selection compared to the market, and we proved it. And third, we want to continue to deliver alpha to our clients. And to do so, we will keep our fund size within the optimal range that we calculate being well inside $1 billion. When a fund goes beyond that point, it is very difficult to have a risk selection that allows you to generate returns which are above the market. With our strategy, we can only invest where we see the best risk-reward profiles. We can avoid investing in bonds that do not display those characteristics. And we believe that, and all I said before, is what will lead Tenax to keep delivering market superior returns.
Thank you, Marco and Toby, for sharing your perspective today, and we hope that this has given you valuable insight into the ILS market.